Good morning and welcome everyone to our daily global markets call. Today is Tuesday, November the 1st, and we start with Asian session update from Edmund in Singapore.
Thank you, Akmal. So Asian markets were mixed with the exception of the Chinese markets, including the Hang Seng, Shanghai, and Shenzhen, which were up about 1%. This was on good Chinese data, where we had the official manufacturing PMI coming in at 51.2, as well as Caixin coming in at 51.2 as well, versus 50.2 expected. This was a two-year high and the fastest rate of improvement since March 2011. The breakdown of the PMI data also suggests that the improvement in conditions was concentrated among small and medium-sized firms and was driven by stronger domestic demand, suggesting that China is in the midst of a cyclical recovery. In Australia, the RBA new Governor Loy has kept the RBA cash rate at 1.5%. There was no surprises here, as there was only a 6% chance of a rate hike given labor market indicators remain mixed and inflation pressures were subdued. Also notable was the RBA governor saying that he is willing to tolerate a weak inflation to avoid stoking briskly rising property prices. In terms of market reaction, we had the Aussie actually rallying. Right now it's trading on its high at 0.76. But in terms of dollar yen, we had a much more subdued reaction in Japan, as the BOJ also did not cut and left the policy rate at negative 0.1%. BOJ also mentioned that a 2% inflation would now only be reached in 2019, while economic activity and prices were skewed to the downside. And lastly, we had US crude declining to about 46.6 after the OPEC meeting over the weekend failed to yield anything concrete, with Iran and Iraq refusing to freeze its output. And that's it from me. Over to John Hardy.
Thanks. Good morning. Thanks, Edmund. Yeah, so we had the first PMIs in the world overnight in China and Japan slightly beating, of course, has got everyone excited about Aussie and the RBA statement as well, as Edmund indicated, also supporting. I think it's interesting to see Lowe's focus on property or asset price risks, which are coming several years too late, and we're probably ironically near the end of that asset bubble in Australia. Regardless, we have a strong Aussie, and you can see a scenario in which it pops higher here if it can take out the 77 area resistance in Aussie dollars. So we'll keep our eyes on that. We also have the BOE's Carney saying he'll stay on until mid-2019, supposedly providing some relief for sterling, although I have no idea why the market would consider Carney hanging around to be sterling positive. Regardless, he's going to be stuck with us for another almost 3 years. FOMC is tomorrow. I think I neglected to mention this yesterday, but entirely I think that they're going to do all they can to avoid creating a profile for themselves ahead of this decidedly ugly political season in the U.S. Expect a very data contingent statement for a December hike, and possibly those three dissenters still complaining they would like to see a hike now, but the dovish core, Brainerd and Yellen herself, among those looking for waiting as long as possible before moving on rate hikes. And that leads us to the other event risks this week, which are the U.S. data, the Bank of England, and the presidential election early next week. Notice PMI is thick and fast all day long, and those that key Bank of England meeting on Thursday, as well as the U.S. data note. And as noted, 5 charges on the 77 area and Aussie dollar, all of them turned back. Technically, though, if we do manage to finally take that out, it does look bullish, but I think we'd probably need to see the other side of the U.S. election to see that scenario coming into play for Aussie dollar. So we've been looking for it lower. We're very skeptical in the long-term prospects for Aussie, but we have to admit there's no decision on the chart just yet, so we'll have to stay tuned for risks both ways here. That's it for me. I'll pass it along. Thanks.
Thank you, thank you, John. So today's focus is obviously that Bank of Japan maintain its policy. I think it's still supportive for Japanese equities, although there was not a lot of action on that part. But let's see whether it works. They still seem pretty confident in their language that they will succeed on the CPI. Well, I think the jury is still out on that one. But for now, I think it's still supportive, and judging from the reaction in the equity market and also in dollar yen. We got, as already mentioned, better than expected the China PMI figures for October, both on service and manufacturing. So I think the big question is, can we can get a rally going again in Hang Seng. I'll come back to that in a short while. We have earnings release out from Shell and BP, both beating on their Q3 earnings. As you know, we're not extremely optimistic on oil, as Ole have said several times over the past weeks, and there's still a lot of headwind in this sector. So, and you can see that from the remarks from both Shell and British Petroleum, that they're extremely cautious and are quoting a very uncertain environment going into 2017. So we have an energy sector that is still stuck in the mud, I will say, and I think you could fade any big rallies in this sector. Barclays, I think it's a pretty interesting news. They're cutting around 25% of their London office space. Obviously, they're ahead of the curve in terms of the Brexit, but also they are adjusting their capacity, and I think it's a general theme that we can see across the wires in London. So looking at some of the big developers like Barratt Development on some of the REITs in the UK market is obviously quite interesting if this trend continues. Then Pandora, the world's largest jewelry maker, reported Q3 that beat expectations. Their revenue were in line. They lifted the outlook for this year's EBITDA margin slightly by 1 percentage point against the previous expectations. And I think there's very little mentioning of outlook except that they actually have just opened new capacity in Thailand. So and they are sort of highlighting in their investor relations or their release that they are ramping up production over the next 2 years with this new facility. So obviously they are betting on continuation of growth over the coming 2 years. In terms of U.S. earnings, we have Pfizer, Occidental Petroleum, and Gilead Sciences. Gilead Sciences are after the market. As you know, we have a long position in Gilead Sciences because we think it's the cheapest and most undervalued of the mature biotechs in the U.S. In terms of trade ideas, we are actually trying to ride some momentum here in the Hang Seng index because of these better than expected PMI October. It's a very short-term trade in nature. It's very tight stop. As you can see, the stop is at the 20,150. So only slightly more than $100 Hong Kong dollar in distance. The target is at 24,000. So depending on what happens with the Bank of England and FOMC, it could be very short term in nature. And if you see here, this is the 5-year chart, and this one is the hourly. So as you can see, we have placed our stop just below these lows here after we got the big pop. So if we break through these lows here, we are out, and we are targeting the 24,000 level over the coming days and weeks. That was all from me.
Thank you, Peter. Carry on talking about the energy markets. You may have seen a small move higher this morning. It's nothing against the big surge we've seen in gasoline, and that's probably why we're seeing oil markets trading a bit higher. The Colonial Pipeline, which carries products from Houston up to the New York Harbor, had an explosion and fire yesterday, which has shut down the pipe. It's the largest pipeline in the U.S., and as a result, gasoline prices are up by 13% overnight. It's the biggest jump since 2008. This is the second time in a month that we've had some problems with this pipeline, and it has been indirectly been providing some support to crude oil. It's obviously going to be temporary, depending on how quickly they can restart it, but probably one of the reasons that we see the market trading a bit higher this morning. Also, the Chinese data that was mentioned also add a bit of support. At least it helps reduce some of the worries about the demand. And but against this, we obviously got the main news still, which is OPEC and the discord and the rising inventories expected to come from show out from the inventory report from the U.S. coming Wednesday. Also in Russia, there's Bloomberg reporting that they are on track to boost their October production to the highest in 30 years. So all the nice words from Putin in Istanbul a month ago, that basically means nothing. Everyone talks, but everyone does the opposite. So this is really not helping this process of trying to reach consensus on cutting production. Gold, meanwhile, is testing 1280 ahead of the U.S. presidential election next week. We're probably not going to see much appetite for selling the market, and that could potentially take us up towards this key area of 1305, which you can see on the chart here. That was a breakdown point, and we had the beginning of October, and that would also be the target for this move. And also, if we start to move away from 1280, we'll also break away from the 200-day moving average, which the market has been climbing around for the past couple of weeks here.
Sugar, sorry, just to mention silver as well. It's currently trading $17.96. $18 is a bit of key there as well. So likewise, if we break above 18, then silver would also find some additional room to the upside. So that's so we're looking for metals to perform at least ahead of the election, and also depending on what the dollar does before and after that. Just finally, sugar is targeting the old 20 to 21.20 range. Long liquidation has kicked off in earnest now. We have been warning about it. The timing of it has been incredibly difficult to call. But now that we're seeing the market starting to slide, then there is obviously quite a big long position in the market that needs to be reduced. And yesterday it lost 2.6%, and following the break below 22.20. So I think we're probably heading for this old consolidation range between 20 and 21.20. I think that's all from us today. I'll pass you back to the host.
Thank you very much, Ole, and thank you all for joining us today. We will live again tomorrow at our usual time, 8:40 CET. Safe trading and have a nice day. Bye-bye.